The economy reeling. The House has passed its version of financial regulation reform. It's called the Dodd-Frank bill. This thing is 2,319 pages. Okay, this is about 150 pages too much, but it'll give you an idea of how big that bill is. Joe Krier is here from Krier Wealth Management. This is a bill that grew to that big a document by 1,000 in the past 7 days. Wall Street Journal this morning says Dodd-Frank financial fiasco. Reform or not?
It remains to be seen. You really won't know. In fact, in one room of Congress, they're still doing discovery by interviewing the president of AIG to try to figure out what happened. In another room, they're passing a bill to fix it. So it seems a little bit odd that before they know completely what happened and how things happened, that they're imposing a fix on us.
You talk to some of the critics and they say that this is based on a misdiagnosis of the financial crisis.
You know, I don't know that it goes that far. I think what's happening here is that there's a couple of simple things that could be put out there to fix it, but it's one of those things that says, okay, if we're going to pass legislation, it's tough enough to get it through. Let's throw everything in that we've been thinking about for the last 5 years.
Does it address the real problems, Fannie Mae, Freddie Mac, bankruptcy code?
Actually, it does not touch Fannie Mae and Freddie Mac, but what it does do is it holds banks responsible for loans they make. I mean, and that's the gist of the whole problem, is that someone could go and borrow money, a bank would give them that loan, and before the bank had any skin in the game, they would turn around and sell that loan to someone else. So essentially, they were making money off of the transaction, not servicing the loan, so they didn't care if it defaulted or not.
So it increases regulation and oversight, reduces risk-taking activities, and it prevents bailouts.
Right. That's one of the big things, is that some say that it doesn't actually accomplish this, but the idea is that rather than giving banks money to survive, it provides a systematic way of liquidating the company so that they just put them out of business. And if you look at AIG, as I mentioned, we put as taxpayers about $160 billion into that company, and it essentially ended up being just liquidated and sold off anyways. Now there's no money to show for it.
All right, that's what it does for Wall Street. What's it do for the people who are watching, for you, for me? Does it provide us with any protections?
Well, yes, it does. And you know, one of the things here is a sole agency to take care of it. Consumer protection has been a piece of about 6 different agencies up to this point. So there was no coordination, you know, and some say like Homeland Security originally was a bunch of different organizations. Now it's all in one spot, and that should help. And then, as I mentioned before, lenders are going to be more responsible. You know, people are going to lose their jobs if a loan goes bad. Banks are going to have to pay personally if a loan goes bad versus being able to sell it off to a third party.
And the bottom line is it basically does away with subprime.
Yes, because, you know, if it's harder, if a bank has more responsibility, they're going to make it tougher to borrow money in the first place. That's how this should have gone and how lending used to be years ago, and then credit became just so abundant that they were pushing money out the door, a la real estate bubble.
Joe Krier, Krier Wealth Management. Always appreciate your perspective. Good to have you here.